Welcome to the Whitwam Wealth Real Estate Podcast. On today's episode, 2026 Vision, Key Areas Every Real Estate Investor Must Watch.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam, and on today's podcast, our topic is 2026 Vision, Key Areas Every Real Estate Investor Must Watch. On today's episode, it's about looking ahead, skipping hype and guessing and strategic ignorance. So whether you're a buy and hold investor, a flip investor, whether you're investing in short-term rentals, 2026 will reward preparation and punish complacency. This will be due in great part to behavior shifts, governmental policy and pressure, capital markets, technology, and added risks. These things separate reactive investors from the resilient ones. This episode is designed to help you spot opportunities early, avoid hidden risks, and adjust strategy before markets force you to do so. So let's jump in. Number one will be spotting opportunities early. There are likely to be some financial opportunities as we come into 2026. Interest rates, we know that they are changing. Debt, calculations, and reserves, and the new costs of capital. I think those are all changing dynamics for the year that we're coming into. And it's pretty clear that this year will bring cheaper money. It almost has to be cheaper money than what we've seen over the last couple of years. We know that Jerome Powell is on the way out as the head of the Fed. The president has been interviewing people to replace him. I know that Kevin Warsick and Kevin Hassick are top two guys on the list. I know both of their views on interest rates are much different than the existing chair. I heard that the CEO of BlackRock was being interviewed. And I think everybody who's being interviewed has the same mindset that really the government should be out of the business of artificially manipulating interest rates based upon history instead of forward-looking. And we need a more forward-looking Fed, somebody who can be more predictive of markets, somebody who actually understands the markets. Jerome Powell may be a nice guy, but he's a lawyer. He's not, I don't think he really understands the concept of where this economy is going. So I think we're going to see some cheaper money in the near future. But this doesn't mean that we're headed back to ultra-low interest rates. I think that the rates that we had back in, from 2019 through 2021 are going to remain historic. People with 2.25% mortgage rates, 3% kind of being the average back then. I've got rental properties that we have 3% investor rates on. And I don't know that we're actually going to get back to those ultra low rates because the economy is improving speedily. There's a lot of investment. There's a lot of construction in the industrial sector, a lot of manufacturing development happening. This is going to mean more jobs. I think we're going to see the conditions for low interest rates exist, but we're going to have strong incomes and strong economies. And I think we're going to be faced with some of the same things that Reagan did back in the late 80s. A guy named Art Laffer, who was part of that administration, talked about the yield curves and some of these different things. And they were faced with the problems. The economy got so good that they were considering, interest rates in order to kind of help cool the economy. Under one of the quarters under Reagan's tutelage and under the Fed back then, we hit over a 7% economic growth rate. And those are kind of hard to sustain. And when you have that kind of growth, a lot of times there's a challenge on prices because of supply shortages, competition, because people have money to compete against each other in the marketplace. So I don't think we're going to get back, all that to say, I don't think we're going to get back to ultra low interest rates, though we do know that rates are coming down. I think investors can be prepared and start to recalibrate their expectations. What this can mean for investors, it can mean stronger cash flow and better margins going forward. Better outcomes when you stress test and analyze deals. And I think that that's been a real challenge a lot of times for our coaching students over the last couple of years in the environment that we've been in the financial environment, in the real estate environment that we've been in. I think there's going to be some refinance opportunities that pencil out, realistic, not hopeful profit margins. Because with lower interest rates, a lot of things ease for you, gives you some more buffers. It even gives you some, for new investors, it gives them some mistake margin. So I think that there will be some real profit margins that we can see in refinancing some of the opportunities that may have been acquired in the last couple of years or financed in the last couple of years. Number two, I think housing supply. Housing supply, imbalances, they'll remain local. I mean, sometimes investors get focused on national trends, but let's remember that all real estate is local. It can be affected by, the job growth in an area, by the manufacturing in an area. It can be driven by demand in an area. It's just, farm country in the middle of, Illinois or Indiana or Iowa is not going to have the same demand as oceanfront property in San Diego. So all, demand trends are going to be localized. And I think sometimes that, we rely on the national numbers. And I think a lot of investors, when I talk to them, they've missed opportunities because they've relied more on the national instead of their local area information. And I think housing supply is going to be kind of driven by that. There's a lot of transitions as we go into 2026 here. I think you're going to see, 2026 bring challenges to some markets. I think that, following U-Haul statistics is an indicator of what areas are losing population and which ones are creating oversupply, how that affects increased days on market and price pullbacks. So, for instance, if U-Haul is identifying a certain area as being a high demand for people that are leaving the state or leaving the area, it's going to create a little bit of a back glut of properties available for sale or available for rent or whatever the issue is. You'll have less demand for your rental properties, probably less demand for your short-term rentals, less demand for your flips and your wholesale deals in those type of areas. And it can affect price pullbacks. So they may look like great opportunities because all of a sudden there's all these properties available and you can get what seem to be great deals, but if there's not the people moving in and there's not the demand on it, that will limit your profitability in those markets. So I think those are things that we need to watch coming into this new year because we're seeing some migrations from some states and some counties to other ones. I think those are things that we can look at and identify some of our local information. Number three, insurance, taxes, operating cost. These are the kind of things that can be budget busters. We do discuss these add-on costs, pretty often, but as a group of investors, we don't hear much about it. Now, of course, in our coaching program, we discuss this with students because we've identified these over the decades as being areas where sometimes that they're not considered in necessarily in the marketplace and how you can leverage these. These costs can be threats to our bottom lines, and I think that they need to really be identified up front. Over the last few years, we've seen the cost of insurance premiums, property taxes, and compliance rising, and sometimes outpacing and out-escalating our escalation clauses in some leases. So you may think, well, yeah, that's okay if taxes go up a little bit, or if these fees go up a little bit, or my insurance goes up a little bit, I've got an escalation clause in my lease. But if you have a 2 or a 4% escalation clause, and the cost of your taxes, insurance, and maybe some regulatory compliance issue, HOA fees and stuff, and if they're running at 6 or 7%, which happens in some cycles or more, you're actually losing money on an annualized basis. So we got to really watch out for those because it can put a hurt on it. Extended periods of times for remodel, and if you're flipping a property, those can have an impact. The good thing for wholesalers is generally they don't have any of these issues to worry about because they're passed on from seller to the final investor. But as investors, we must pay attention to these, what I call little foxes. They're just kind of little things that are nipping there and chewing away at the profits. So I would say this, shop your insurance, at least annually. Shop your insurance. Make sure your insurance carrier is treating you right. What I've noticed is most insurance agents, once they have your business, they don't pull up annual reviews and do the reevaluation for you and call you and go, hey, we can save you a lot of money on your insurance. No, they just hope that you don't get lower insurance because they get paid upon the base insurance for their commission. But if you'll do this, you may end up moving insurance carriers, but you may end up saving thousands of dollars on things like insurance. Challenge property tax assessments. I've done this in the past where you get a new property tax valuation or assessment, and it's crazy, the escalation in it. Now, some states have limitations on what property taxes can be raised on an annualized basis, but if we've been in a kind of a declining sales market last couple of years, some areas have had pullback in prices, and so you may want to challenge a property tax assessment. It may be worth the effort and save thousands of dollars in property taxes. And then again, make sure you have, if you're in the rental business, make sure you have annualized escalations tied to inflation so that you have some fallback. You can make your escalation clause in a lease, 2%, 3%, 4%, 5%, whatever it is, and then say, or the rate of inflation, whichever is greater. And you can have those escalation clauses tied into most lease agreements to protect your downside. Number 4, short-term rentals and regulatory reality. There have been many changes in the short-term rental industry. So for investors who've got into the short-term thinking that Airbnb was all the rage and this was the answer to retirement, the Airbnb issues caused by bad tenants have really caused many communities, HOAs, and cities to regulate these type of short-term rentals. Way too many big bashes and parties, communities left with garbage and trash and the cleanup, and that's created a lot of problems. So that type of short-term rental has been under a lot of pressure. There's still good opportunities there, but it's been under a lot of pressure. But it's given rise to things like co-living. When it comes to co-living, my choice is pad split. In the areas where pad split is operating, I think that they have a great model. Now, it's not the Airbnb rent a house for a weekend, but it can be a solution for turning something that you may have wanted to be an Airbnb into a shared or co-living rental model that can generate equal revenues that you had in your Airbnb model when fully rented. So it's something worth looking into. Here in Phoenix area, Gina and Brian Kandesky, they've been here on the podcast many times. They're the go-to for co-living and pad split. Gina's the pad split representative now for the Phoenix area. And their system is profitable and avoids a lot of these restrictions. So I certainly would recommend, getting hold of a pad split, representative and look at how that can benefit you in your community or in wherever it is that you're investing. I think we're going to see even more restrictions on the short-term rental market this year. I keep hearing from people that, hey, my HOA is outlawed nothing less than 30-day rentals now, and I think you're going to see that back to some entire jurisdictions. Some cities have just said, hey, short-term rentals aren't allowed in the city anymore. It has to be a rental of 30 days or more. So I think you're going to see some more of this coming. Enforcement will be stronger. I think you're going to see some fines and penalties that basically wipe out profits. It may be worth, and I know some people that have done this, it may be worth converting those assets. When interest rates get a little lower, I think we're going to have a stronger buyer's market probably towards the middle or end of the year, and convert those assets, and then maybe move into a co-living model if you want to continue to do that, or back into a traditional rental model. But I will say not all of the opportunities are gone in the short-term rental market. There's some areas where the Airbnb still makes sense. Communities actually like them. It brings tourism into the area. So, again, all real estate is local. You got to know what's going on in your area. You just need to stay up on what's transpiring, in your investment areas. Number 5, technology, AI, and data-driven investing. Technology will never replace human investors, but it'll make it more difficult for the unprepared investor because AI is really changing things. Technology is really changing things. So certainly in 2026, we'll continue to see investments in AI and the automations inside of our industry. The way deals are analyzed, rental pricing, valuation, tenant screening, maintenance, management, and more. And being an engaged investor is important to stay on top of this. You got to know which tools improve your decision making. Avoid shiny tech that doesn't add value. Here's what I find a lot of times, and because I see this in our investor meetings that we go to every now and then, and you have somebody, oh, this greatest thing in the world, I paid this for it, and it does all this, and really when you dig into it, it's just kind of that shiny toy that's good for bragging about. It's like if all you do is drive to the grocery store and back, you don't need a Lamborghini. The only reason you'd buy a Lamborghini to drive to the grocery store and back is you want the bragging rights. And sometimes some of these new technology tools, it's about being able to brag to your friends about what you got going on. But there are some solid tools out there, and we can use technology and these kind of data to enhance our confidence and reduce what I would call emotional mistakes, making decisions based upon emotions. These will help to clarify and give us better data. And I think that we're all going to be more and more moving into this. I was in technologies for a lot of years. I remind people, with all this talk about AI, and it can have a sinister side, but AI is just a fast way of searching a database. So it's no different than, the GPSs we've used for 15 years. It's no different than the search engines we've used for 15 years. They've just managed to take these data sets and made them accessible at much faster rates to be able to enhance technology. And because they can do that, they are now starting to put kind of human interaction to it and trying to connect the two. But if the right tools, the right way can actually give you an advantage over other investors. And for the investors who are doing it the old-fashioned way, they're going to be slower to the opportunities than you are, and they're probably going to make more emotional mistakes than you are because it's going to give you a better set of numbers, a better data set. Number 6, investor competition and corporate money coming into 2026. As the cost of money starts to pull back, traditional markets will tighten up. Typically, that's the way it works. When money gets cheaper, lenders get tighter with their qualifications, and they start to restrict how liberal they are because the upside for them begins to diminish. If you're getting 30% interest on a credit card, you can take a lot of risk with people who may not have the best track record for payment history. But if you're getting 4% on lending out money on a mortgage or on a real estate investment, your qualification is going to be much tighter because you can afford much fewer defaults. And so the traditional markets will start to tighten. However, generally the opposite effect occurs in the hard money sector. As money becomes cheaper, private hard money becomes easier to get. The reason? The perception is that there's less risk to the investor as assets can be liquidated quicker if needed. See, when interest rates are lower, there's typically more active buyers. And so if you default on a hard money guy when interest rates are lower, it's much more likely that they can sell and recoup their money and recoup their potential losses much faster. In a time when there's higher interest rates, there's less buyer activity, and if they have to repossess an asset in those conditions, it's much tougher for them to liquidate it, and they have to sit on that asset much longer or take a much bigger haircut or loss on liquidating. So the lower cost of money will undoubtedly create more competition coming into this year. As self-anointed expert investors, they crowd back into the market. They're going to put pressure on the market. But there's also another player lurking in the shadows, and we have been dealing with these as investors for a lot of years, and that's big corporate investors or the Wall Street money. See, they're watching the same markets you are, and generally they're doing it with better data sets and deeper pockets. I would expect institutional capital to continue targeting single-family rentals. As a side note, this is one of the reasons why, President Trump has suggested a moratorium on corporate investing into single-family residences so that we can start to get people back into home ownership, that they're not competing with the Wall Street guys. But on this matter, in principle, I think it's a bad idea. I think anytime that you limit the free choice of corporations, you're actually limiting the free choice of people. And in America, I think our system of the ability to make money, free choice, unrestricted trade, I think supersedes the benefits that would be there. I think there's actually a better idea, and Congress has used this since the implementation of the income tax system. You could actually take away a lot of the tax breaks that corporate investors and Wall Street investors get. Remove the deductibility of certain expenses on single-family purchases and make it less desirable and less profitable maybe for the corporate individuals without telling them they can't buy something, restricting their free choice, their liberty to buy something, but using the tax code in order to benefit maybe individual homeowners, first-time home buyers, people who only own one or maybe two residences, those type of things. I would rather see the tax system used, not that I'm super fond of our taxing system, but I think it's a better way to regulate this and allow the freedom in the marketplace to continue to operate. But let's go back here to the Wall Street money. I think that we're going to be competing with a group of Wall Street and iBuyers for quite a while. I think that there's no doubt that there's profitability. I think we're certainly going to be doing that in this year in 2026, and that's really kind of the focus of this. Where that lands us in 27 and 28, I think there's going to be some sound policy that helps to, again, bring back the housing market. But really the solution for us as, individual investors and individual investing businesses is to find the niche where you can operate, where you're not competing head to head maybe with those type of iBuyers. And, personally, I like off-market and direct-to-seller opportunities in order to accomplish this. I find that's a very good marketplace, and it can be scaled. I have a lot of friends that are doing it to scale, and it's working really well for them, and they're not having near as much competition with some of the the BlackRocks of the world. Number 7, risk management has got to be part of your growth strategy here in 2026. There have been seasons in the past where growth was about doing more and accumulating more, doing more flips, doing more wholesale deals, acquiring more rentals, all about the more. But it can't just be about more properties. I was at a recent invitation-only investor forum, and when I attended there, it seemed like there was a consistent theme among the speakers and the attendees during our discussions and those type of things that doing more doesn't always scale to greater profitability. Sometimes doing more just creates more headache. You have more overhead. You have more expenses. There's more complications. And it doesn't necessarily lead to more profitability. You can start doing, 10 times the volume and making a fraction of the amount that you were making before you scaled the volume up. And many have learned that sound real estate investing has to be guided by sound numbers. We want to have the profitability. So if our profitability can stay good at a smaller volume, maybe you're only doing, 3 or 4 flips a month. Maybe you're doing 1 flip a month. Maybe you're doing 4 flips a year. Like some friends of mine, maybe you're not doing 30 flips a month. Maybe you're doing 15 flips a month. And wherever that is, you can scale in and be guided by the sound numbers. That's where you want to be. So, the numbers, the margins, and the scale, when you do that, when you get hold of those things, they can be crash bumpers, saving an investor of any size, just like an airbag in a car crash. So we scale, we make sure the numbers are right, and we use that as our bumper. And being able just to say, hey, look, I'm, the number one guy in this market because I do this many, and then going home at night going, yeah, but I'm not making any money because my overhead has grown exponentially. So we got to watch those kind of things. Managing risk may not sound sexy, but it can deliver profits in good times, and it can keep profits in the down times. For the coming year, part of our focus should be on some of these risk-adverse moves, developing strong reserves, well-developed leverage plans. If you plan only works in a high market, then you have lots of downside risk. If it only works when everything is great, if there's a market reset, now all of a sudden you have all of this risk. And we saw that happen quite a bit for investors in 2022 and 2023. Diversification, not division. There's a difference in diversifying risk class versus dividing your investing into multiple companies with multiplied expenses. So sometimes when we talk about diversification, people think, well, that just means that you add another division and now you've got duplicate costs and expensive. But if we can just diversify it and build it into the same framework we are so that we can create revenues from a similar source, then I think that it brings our profitability up, and it can help hedge against certain downturns within this market that we're in, real estate investing market that we're in. And always have good exit strategies, and consider this with regards to multiple market conditions. What would my exit strategy be if the real estate market is at its best? And what would my exit strategy be if the real estate market is its worst? And for years, I've been going into investments like that and making sure that we had downside coverage in addition to having upside goals. So the one thing that always stays consistent is that there will always be change. So remember the what if. What if interest rates go higher? What if the rental market flattens? What if leverage tightens? Or you need to get out of a property fast? See, wise investing is planning for survival than having a plan that operates at scale. So for 2026, let's pay attention to the details that other people ignore. Adapt faster than the market. Work on building an investing business, not just a portfolio. Hey, I want to thank you for listening. If you found today's episode interesting, be sure to subscribe, leave us a review, and share it with another investor who could use to hear this information. That's all for this episode. Thanks for joining the Whitwam Wealth Real Estate Podcast. Be sure to check out our previous episodes on real estate investing topics. I'm glad you're part of our growing real estate community. You can always find the Whitwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart Podcasts, YouTube, or wherever you enjoy listening to podcasts. This is Scott Whitwam. Be sure to join me on our next episode of the Whitwam Wealth Real Estate Podcast, where we're wealth building through real estate.